Two superpowers just agreed to solve their trade war by forming a committee. According to the readout from Trump's two-day Beijing summit, the United States and China will now manage their $30 billion relationship through a shiny new Board of Trade and a Board of Investment. Because nothing says breakthrough like creating a subcommittee. Treasury Secretary Scott Bessent and Trade Representative Jameson Greer pushed these boards as a pre-summit priority, and Xi Jinping wrapped the whole thing in a phrase so sterile it could have come from a hospital brochure: constructive strategic stability. You'd think a presidential trip to Beijing would produce a deal worth talking about. The data says the opposite. The headline deliverable was 200 Boeing jets, which sounds enormous until you remember earlier speculation centered on 750. No resolution on NVIDIA H200 chip exports. No movement on rare earth export controls. No concrete commitment from China to pressure Iran on the Strait of Hormuz. The summit produced warm handshakes, a phrase Xi will print on commemorative plates, and a purchase order that disappointed the one American manufacturer everyone was watching. Picture the scene. Trump steps off Air Force One, waves to the cameras, and later stands beside Xi in the Great Hall of the People. 2.5 hours of conversation. Xi leans in and warns that American intervention in Taiwan could trigger a highly dangerous situation. Rubio, standing off to the side, later tells reporters that Taiwan arms sales weren't really a major focus. Meanwhile, Congress has a $14 billion arms sale to Taiwan sitting on Trump's desk. Nobody mentions it at the podium. Everybody knows it's there. Then came the part that might actually haunt the midterms. Trump publicly endorsed 500,000 Chinese students studying in America and suggested China should be able to purchase U.S. farmland, arguing that without both colleges and farm prices would collapse. Try selling that at a rally in Iowa. Vote for me. I saved your soybean prices by letting Beijing buy the field. Xi secured his narrative of predictability. Trump got a photo op and a Boeing receipt. The real test arrives in September when Xi visits the White House, and that Taiwan arms package is still sitting there like a grenade on the coffee table. Which brings us to another explosive device disguised as good news. A $100 million investment just saved a stock that lost 83% of its value, and the market called it bullish. Tyler and Cameron Winklevoss injected $100 million into Gemini space station, their publicly traded crypto exchange, buying Class A shares at $14 each in a Bitcoin-funded transaction. The stock popped 20% in pre-market. It closed the day before at $5.26. It went public in September 2025 at $28. So congratulations. The twins just paid nearly triple the market price for shares of their own company, and everyone acted like the cavalry arrived. On paper, founders paying a massive premium for their own stock screams absolute confidence. Wall Street analysts took one look at the math and laughed. Evercore's Adam Frisch wrote that without the strategic investment, the stock would likely be down on the print because key metrics like user growth and revenue reacceleration fell well short of pre-IPO expectations. First quarter loss was $109 million. Revenue was $50 million. That is a company burning $2 for every dollar it earns. And the cure is apparently the founders wiring themselves more money. Tyler Winklevoss, standing somewhere between a press release and a prayer, declared that the market has significantly undervalued Gemini and that the exchange is evolving from a crypto company into a markets company. Short interest sits at 21.5% of the float, 5.3 days to cover. The shorts looked at a company down 83% from its IPO, losing 9 figures a quarter, and said, yeah, this still has further to fall. Then the founders showed up with a Bitcoin-funded lifeline, and suddenly those shorts are staring down a squeeze. Mizuho called it a solid start. Truist said the capital injection may alleviate balance sheet concerns. May. The most honest word on Wall Street is always the conditional one. Here is what nobody will say out loud. When founders buy shares of their own company at $14 while the market prices them at $5, either they know something transformation out that justifies a 166% premium, or they are building a floor under a building that is already on fire. The exchange went public 8 months ago. It has lost 83% of its value. And now the cure is the same people who listed it, paying themselves a premium to keep the lights on. Somewhere. A short seller is refreshing the borrow rate and whispering, "Let them squeeze me. I'll be back in 6 months." But at least the Winklevoss twins have conviction, which is more than you can say for the people who think the 1970s are coming back to destroy your portfolio. Stagflation is the most profitable word in financial media right now, and almost nobody using it understands the expiration date. Lance Roberts at Real Investment Advice just published a piece dismantling the doomer stagflation narrative that dominates financial social media. His core argument is surgical. The inputs are real. Supply chains are constrained. The dollar faces headwinds. Central banks are hoarding gold at roughly 585 tons per quarter. JP Morgan projects gold at $5,000 per ounce by 2026. Every one of those data points is defensible. The leap from those observations to sell everything, buy commodities, bonds are dead forever, is where analysis ends and content creation begins. The conventional wisdom says, a commodity supercycle means you back up the truck for hard assets and go to sleep. The structural data tells a much darker story. The 1970s stagflation playbook worked because manufacturing was 25 to 28% of GDP, and unionized workers had cost of living adjustments baked into their contracts. Prices rose, wages chased them, spending survived, and the cycle ran for years. Today, services are 70 to 75% of the economy. Manufacturing is 11%. The cost of living adjustment workforce is gone. When commodity prices spike now, consumers eat it immediately. What took years to produce demand destruction in 1973 shows up in 6 to 12 months. The doomers modeled a feedback loop that no longer exists. Imagine a guy at his desk. 3 monitors glowing, gold charts on all of them. He records a video. The dollar is collapsing like gold. Escape the system. He posts it. It gets 400,000 views. He never mentions that gold is priced in dollars, traded in dollar-denominated markets, and that its entire value proposition is measured against the purchasing power of the currency he says is dying. Central banks buying gold aren't escaping the monetary system. They are rotating within it. The Chinese People's Bank is reducing its treasury concentration, not building a bunker. Roberts walks through the full inflation sequence, and it plays out like a financial haunted house. Commodity prices rise. Consumers, already carrying enough credit card debt to fund a small navy, suddenly stop buying things. Business investment slams the brakes. Growth chokes. Then Jerome Powell panics and pivots. Rate cuts follow, and boom, bond prices rise. The exact same event that murders the commodity rally, what resurrects the bond market. The Fed pivots. Rate cuts follow. Bond prices rise. The same event that kills the commodity rally launches the bond recovery. We watched this exact movie between 2022 and 2024. Commodities surged on the Russia-Ukraine shock. Bonds had their worst year in modern history. The doomers called it permanent. Then growth wobbled. The Fed pivoted, and intermediate treasuries recovered sharply while commodity prices corrected. Meanwhile, the AI capital expenditure cycle is pumping hundreds of billions into domestic infrastructure. Microsoft, Oracle, Google, Amazon, and Meta are on track to spend $1.1 trillion on AI build-out by 2027. Nearly 75% of the 2% annualized GDP growth in Q1 2026 came from business investment in data centers. The doomers never modeled that either. The most dangerous part is the exit. Roberts points out that the Doomer framework is built to profit from the first two phases of the inflation sequence and has no plan, no framework, and no exit discipline for phases 3 through 6. That is where the damage happens. Oil hit $100 a barrel for 3 straight years around 2011. Peak oil narratives were everywhere. Then producers flooded the market. By early 2016, West Texas Intermediate traded at $26. The cycle does not announce its end. It just ends. And the people still holding concentrated commodity positions are left staring at a chart that looks like a man who walked confidently off a cliff and hasn't looked down yet.